1. Australia's unemployment rate hits 4.3%, what it means for jobs and interest rates. 2. ASX 200 hits record high, banks and rate-sensitive stocks led rally. 1. Australia's unemployment rate hits 4.3%, what it means for jobs and interest rates. Australia's job market is sending mixed signals, and it's sparking a heated debate among economists. Is the country's economic resilience starting to crack? Here's the lowdown. Australia's unemployment rate ticked up to 4.3% in June, a notable rise from May's 4.1%. This increase comes on the heels of the Reserve Bank of Australia's (RBA) surprising decision to keep interest rates steady, a move that's now being questioned by some experts. But here's where it gets controversial. While the unemployment rate rose, employment also grew by 2,000 jobs. So, what's really going on? And this is the part most people miss. The increase in unemployment was driven by a surge in the number of people actively looking for work, which grew the labor force by 35,600. This pushed the participation rate up slightly to 67.1%, just shy of its record high. However, the devil is in the details. Part-time jobs grew by 40,000, while full-time positions shrank by 38,000, leading to a drop in total hours worked and a slight rise in underemployment. Youth unemployment, in particular, jumped to 10.4%, its highest since November 2021. Is this a temporary blip or the start of a worrying trend? Economists are divided. Abhijit Surya from Capital Economics calls the RBA's decision a policy error, while Harry Murphy-Cruz from Oxford Economics Australia urges the RBA to get a wriggle on with rate cuts. Federal Treasurer Jim Chalmers attributes the rise to global economic uncertainty and higher interest rates, but remains optimistic, highlighting Australia's historically low unemployment and near-record participation rates. Yet, some economists argue the labor market is still tight, with job vacancies high and firms reporting labor shortages. Paula Gadsby from EY notes that the unemployment rate aligns with the RBA's forecasts, suggesting the market is performing as expected. Callum Pickering from Indeed, however, criticizes the RBA's decision to hold rates, calling it misguided. Meanwhile, David Bassanese from BetaShares cautions against overreacting to a single month's data, emphasizing the need for more consistent signs of weakness. Westpac's Ryan Wells points out that the surge in youth unemployment is a key driver of the overall increase, though he acknowledges it could be partly due to data noise. So, what's next? Interest rate cuts in August are on the table, but it all hinges on next week's inflation report. Is the RBA moving fast enough, or are they risking further economic slowdown? What do you think? Are we overreacting to June's numbers, or is this the beginning of a broader labor market downturn? Let us know in the comments. 2. ASX 200 hits record high, banks and rate-sensitive stocks led rally. In a surprising twist, bad economic news just propelled Australia's stock market to unprecedented heights. The ASX 200 index shattered records today, closing at 8,639.00, its highest level ever. But here's where it gets controversial. This rally wasn't driven by economic strength, but by rising unemployment that paradoxically signals potential rate cuts. And this is the part most people miss. The market's celebrating weakening fundamentals as a path to cheaper money. Driving the surge were banking giants and rate-sensitive stocks, with Commonwealth Bank leaping 1.8% to $180.80, while Westpac, ANZ, and NB each gained over 1%. The catalyst? June's unemployment rate unexpectedly climbed to 4.3%, significantly higher than the forecasted 4.1%. This bad news is good news scenario immediately pushed market expectations for an August rate cut to 94% probability, sending bond yields tumbling 5 basis points to 3.45% and weakening the Aussie dollar to US 64.83 cents. AvaTrade's Kate Lehman captured the mood perfectly. Investors appear to be welcoming the growing likelihood of monetary policy easing, especially as inflation appears to be moderating. However, she added a crucial caveat: sticky inflation in the upcoming June quarter data could force the Reserve Bank to reconsider. This creates a fascinating tension. The same economic weakness fueling today's gains might eventually undermine the rally if price pressures don't cooperate. Beyond financials, the real estate sector roared back with Mirvac surging 3.2%, while tech stocks got a 5.1% boost from Afterpay owner block. Iron ores rallied to $100 and 90 cents per ton, despite China's weakening steel demand, lifted miners Rio Tinto and Fortescue. But the news wasn't universally positive. Cars Group sank 2.9% after announcing its CFO would replace longtime CEO Cameron McIntyre. The betting sector saw drama with PointsBet receiving competing bids, a $1.03 per share scrip offer from Better Entertainment, and a $1.20 per share cash proposal from Japan's Mixi. Qantas gained 0.6% after securing a court order blocking publication of stolen customer data, while Alcoa climbed 1.7% despite absorbing $115 million in surprise aluminum tariffs. Here's where opinions collide. Should we really cheer economic deterioration as an investment strategy? Does this market reaction signal dangerous short-term thinking? Share your take in the comments. Do you believe this bad news rally is sustainable or a precarious bubble?